Welcome back to Iron Financial. This is The Explainer, where we help you forge a much stronger portfolio and cut right through all the market weakness. I'm your lead analyst, and today we are running a comprehensive structural integrity report on a company that has absolutely been put through the ringer over the last few years. We're talking about Zoom Video Communications, and we're going to dig deep into their Q1 fiscal year 2027 numbers.
Okay, let's dive into this, but honestly, I gotta ask right out of the gate, why are we wasting our time looking at Zoom? Look, I represent the folks at home, and to a whole lot of us, Zoom is just this crumbling pandemic relic. I mean, think about it. Tech budgets are tightening across the board right now. Companies are pushing hard for in-person offsites again. And you've got Microsoft Teams actively bundling its way into practically every corporate enterprise on the planet. Are we really gonna sit here and spend the next 10 minutes inspecting the foundation of a building that everyone evacuated years ago?
Actually, that is exactly why we are looking at it, because the broader market has priced this stock like it's a complete teardown. But the hard numbers in this Q1 report, they suggest a completely different architectural reality. Today, we're going to drill down into the revenue, the debt, and the margins to see if this business is truly built with reinforced steel or if it's just crumbling concrete. While I'm highly skeptical, is the recent hype around Zoom just a fresh coat of paint over a weak foundation? Because I keep hearing their management talk about AI, but let's be real. Every tech company out there is slapping an AI label on their earnings releases right now just to keep their stock prices from collapsing. It's a completely fair question. Is it a relic or is it an AI powerhouse? See, the market has been operating on this lazy assumption that Zoom is just a pure-play, single-function video app, but management is aggressively trying to pivot that narrative toward a multi-product, AI-driven platform. And to figure out if this is reality or just some glossy brochure, we have to ignore the narrative entirely. We have to look strictly at capital allocation. Because talk is cheap, but in a high interest rate environment, capital allocation is the ultimate lie detector test for a board of directors. How a company deploys its cash, that tells you exactly what they really think about their foundation. And this number brilliantly illustrates management's confidence. Boom, a brand new $1.0 billion incremental share buyback authorization.
Wait, $1 billion just for this single quarter? No way.
Authorized this quarter, yes, and notice the word incremental, meaning it is piled right on top of the $625 million they already had remaining on their previous authorization as of April 30th. So if you do the math, we are looking at roughly $1.6 billion in total buyback firepower. And they already repurchased 4.2 million shares for $362 million in Q1 alone.
Okay, I have to admit, that definitely gets my attention. A buyback of that size reduces the number of shares outstanding, basically shrinking the pie so each remaining slice gets a much larger claim on the future profits. But isn't that just using cash that could be spent on R&D or growth?
It could be, absolutely. But when you have the sheer, overwhelming cash generation that Zoom has, which we'll get to in a minute, a buyback of this magnitude is the ultimate hard hat maneuver. The board is looking at their stock price, they're looking at their immense cash flow, and they're saying, the market is dead wrong, our foundation is incredibly solid, and we're going to buy our own equity at a massive discount. They aren't just reinforcing the foundation, they're buying out the other landlords because they know the property value is about to spike. All right, now it is time for the drill down. Let's look at the top line. Q1 FY2027 total revenue came in at $1.239 billion. That is a 5.5% increase year over year, or 4.6% in constant currency, which, just as a quick reminder, simply means adjusting for the fluctuating value of the dollar overseas so we get a true apples-to-apples comparison.
Wait a second, 5.5% growth for a software-as-a-service company? That isn't exactly explosive. I mean, that barely outpaces inflation. Why in the world is Wall Street cheering for mid-single digits?
Because it solidly beat Wall Street's $1.22 billion consensus estimate. Look, the market was pricing in stagnation or even outright decay, and instead, what did they get? Steady, load-bearing growth. You have to remember, Zoom is actively transitioning from a hyper-growth pandemic beneficiary to a mature, highly durable enterprise platform. When a massive structure matures, you aren't looking for rapid, chaotic expansion anymore. You are looking for stability. You want consistency. And hitting $1.239 billion on the top line proves that the core business is absolutely not bleeding out. It is holding firm, and it is expanding. But where this report gets truly fascinating is the profitability. The GAAP operating margin hit 25.1%, jumping a massive 450 basis points or 4.5% year over year. But check out the non-GAAP operating margin, a staggering 41.1%.
Wow. A 41.1% operating margin? That is incredibly thick.
It puts them at the absolute top tier of their software peers. That's a 130 basis point expansion from the prior year. And it translates directly to the bottom line, right into earnings per share. GAAP EPS was $1.42, which is way up from 81 cents a year ago. And the non-GAAP EPS hit $1.55, cleanly beating the high end of their own guidance and completely crushing analyst estimates.
So the crucial takeaway here is that even if their overall revenue is only growing at 5.5%, their incredibly disciplined cost structure means they are squeezing significantly more profit out of every single dollar that comes through the front door.
Hit the nail on the head. Exactly. They aren't sacrificing the structural integrity of the business just to buy top-line growth. They are rigorously, methodically optimizing the machine. Which brings us directly to the balance sheet. And honestly, I call this the fortress. Zoom generated $500.5 million in free cash flow just in the first quarter alone. That is up from $463.4 million in the same quarter last year. And their total liquidity, what are they sitting on? Try $7.7 billion in total cash, cash equivalents, and marketable securities. And here's the real kicker for you, zero net debt.
Zero debt. Okay, let me just pause you there for a second. For the everyday investor listening right now, what does zero net debt actually mean in today's rough macroeconomic environment?
It means everything. It means while their competitors are choking on massive debt servicing costs because of these elevated interest rates, Zoom gets to keep every single dollar it earns. They don't have any massive refinancing cliffs approaching in the next few years. None. That $7.7 billion is the ultimate rebar reinforcing this balance sheet. It gives them total, uncompromised optionality. They can buy back stock, they can aggressively fund R&D, or they can make highly strategic acquisitions, all without borrowing a single dime at current interest rates. This is simply not a distressed asset, folks. All right, I'll give you that. The financials are undeniably solid. But come on, let's run a segment stress test. Not everything can be perfect here. Where are the cracks in the armor?
The cracks are exactly where you'd expect them to be honest, the online segment. Zoom's business is fundamentally split into two load-bearing pillars: enterprise, which represents the direct, massive sales to big corporations, and online, which is your individual consumers, or very small businesses swiping a credit card on the website.
Right, and the online segment is basically the pandemic hangover, isn't it?
Precisely. Online revenue was $483.3 million. That's technically up 2.8% year over year, but the online average monthly churn crept up to 3.0%, compared to 2.8% a year ago.
Hold on, let's talk about that. Isn't a 3% monthly churn fatal over a 5-year horizon? That literally means they're constantly having to patch gaping holes in the roof just to maintain that baseline revenue.
It is absolutely a serious headwind. Yes, we're not ignoring that. But here is the counterbalance. Enterprise revenue, the true core structural pillar of this business, grew 7.2% year over year to hit $755.7 million. The enterprise side is now doing the heavy lifting, accounting for the vast majority of the top line and successfully offsetting that online decay.
And to really prove just how strong that enterprise pillar is, we just have to look at one metric, their trailing 12-month net dollar expansion rate. It is sitting strong at 99%.
NDER. Okay, what exactly is that measuring for us?
So for the audience, net dollar expansion means that even when you factor in the enterprise customers who decide to leave or downgrade their plans, the remaining customers are actually spending more money with Zoom than they did a year ago. They are nearly replacing all the lost revenue entirely on their own.
Oh, I see. So if Zoom didn't sign a single new enterprise client tomorrow, their existing base would still pay them 99 cents on the dollar compared to what they paid last year?
Exactly. A 99% NDER is quite literally the structural steel holding the entire bullish thesis together here. It proves that once a large organization embeds Zoom into its daily workflow, they stick around. And not only do they stick around, they buy more licenses, they add more modules, and they pay for more features. We can clearly see that loyalty forged in the large contract data. At the end of Q1, Zoom had 4,534 customers contributing more than $100,000 in trailing 12-month revenue.
Market Skeptic. Now that is serious enterprise commitment. That's not just a casual subscription.
Yes, and that specific cohort of high-paying customers grew 8.2% year over year. You have to realize, these aren't temporary pandemic subscriptions anymore. You don't sign a $100,000 annual software contract on a whim. These are deeply integrated IT decisions. Think about it. Once you integrate Zoom into your global corporate directory, your calendar systems across thousands of employees, your physical conference room hardware, ripping all of that out is an absolute logistical nightmare. That is exactly why these enterprise contracts are ironclad. The enterprise segment now constitutes the rock-solid core of Zoom's revenue base, and it heavily insulates them from the churn we saw in that online segment. Okay, lead analyst, I'll admit you've convinced me that the enterprise base is sticky and the balance sheet is made of iron. But let's do a real AI hype check right now. Because when we cross-reference this directly with the Q1 press release, management is talking a massive game about AI. But I need hard proof that this isn't just a gimmick to appease Wall Street analysts. Like I said earlier,
every CEO is saying AI 50 times on their earnings call.
And I totally respect the skepticism. It's needed right now. So let's ground this AI narrative in audited reality straight from the source material. Zoom isn't just bolting some cheap, off-the-shelf chatbot onto their video interface. They are completely re-architecting how the platform functions on the back end.
Let's break down Zoom's federated AI architecture. This is the highly sophisticated machinery running under the hood. Instead of relying on just one massive, incredibly expensive AI model, Zoom uses what's called a federated approach. They use their own proprietary small language models for the basic everyday tasks, and then they dynamically switch over to trusted third-party large language models, like OpenAI, Anthropic, or Meta, only when the user actually needs the heavy lifting.
Okay, but why does that matter structurally? Why not just use OpenAI for absolutely everything and make it easy?
Because AI inference costs are arguably the single biggest threat to software margins in the industry right now. Large language models are incredibly expensive to run. If you use a massive compute-heavy model to summarize a simple 5-minute check-in call, you are literally burning cash for no reason. By dynamically selecting the right tool for the job, a small model for simple tasks, a large model for complex ones, Zoom optimizes for flexibility, maintains incredibly high quality, and drastically lowers their computational cost. Zoom's routing system is a brilliant defensive moat, and that structural efficiency is a major reason why their non-GAAP operating margin is sitting at an unbelievable 41.1%.
Okay, brilliant engineering, sure, I'll give them that. But let's get down to brass tacks. Is this technology actually monetizing? Are real, tangible businesses paying for it right now?
The data says absolutely yes. AI Companion paid users grew an absolutely incredible 184% year over year. The Zoom Revenue Accelerator, which is their AI tool specifically built for sales teams, saw a 50% increase in customers across the fiscal year. Their brand new My Notes feature, it reached 1.5 million licensed users in just 4 months flat.
And what about that BrightHire acquisition they kept mentioning? What's the play there?
That is a highly strategic move. BrightHire is an AI-powered hiring intelligence platform. Zoom acquired them to embed their AI much earlier into corporate decision-making processes, specifically targeting high-value hiring workflows. It's all about taking the platform from being just a simple meeting app into specialized, mission-critical vertical markets. It dramatically increases the overall platform stickiness we were talking about earlier.
Which brings us to the grand vision. CEO Eric Yuan stated customers are increasingly adopting Zoom as an AI-first system of action for modern work.
System of action. Okay, come on. That sounds like pure marketing speak. What does system of action actually mean on the ground for an employee?
It means transitioning from a passive communication tool into a completed workflow engine. Look, during a meeting, agentic AI, meaning the AI isn't just a chatbot sitting there waiting to answer basic questions, it is an active agent, is taking notes, assigning tasks, auto-generating follow-up emails, and automatically updating your CRM in the background while you talk. Take Zoom Workplace for clinicians, for example. It's actively automating clinical workflows to reduce the massive documentation overhead for doctors. Zoom isn't just the room where you talk about the work anymore, it is becoming the machinery that actually executes the work.
And the successful transition is giving management the supreme confidence to upgrade the blueprint for the entire year. Their updated FY2027 guidance proves it. They raised their targets across the board. They are now projecting full-year revenue between $5.080 billion and $5.090 billion.
And the bottom line, did that go up too?
Upgraded as well. Non-GAAP EPS is expected to be between $5.96 and $6. And they expect to generate between $1.700 billion and $1.740 billion in free cash flow. This is management clearly telegraphing to the street that they expect durable, highly profitable, mid-single-digit growth for the entire year. The foundation is poured and it is set.
So it is finally time for the verdict. Is Zoom a structural opportunity, or is it just a classic value trap? Let's weigh the evidence.
Well, I'll take the trap side of the ledger to start. We are talking about real, heavy macroeconomic risks here. You've got extremely tight IT budgets, you've got massive, aggressively well-capitalized rivals like Microsoft and Google fighting for the exact same space, and we absolutely cannot ignore that 3.0% churn rate in the online segment steadily eroding the base. There are deep cracks in the concrete for sure.
I hear you. Those are valid concerns. But on the opportunity side of the ledger, we have a fortress balance sheet with $7.7 billion in liquidity and absolutely zero net debt. We have expanding margins topping 41%, we have a highly sticky enterprise base driving 7.2% growth, and we have a ridiculously smart, cost-effective, federated AI integration that is actively monetizing and driving massive user adoption right now. So, here is the Iron Financial final call. Zoom is no longer the hyper-growth darling of 2020.
That building, it's gone. What stands in its place today is a mature, cash-printing, high-margin enterprise software platform with a severely misunderstood valuation.
So definitely not crumbling concrete then.
Far from it. The sheer volume of free cash flow and that massive $1 billion Buyback Authorization act as reinforced steel under this stock. They are cutting through the market weakness with intense, disciplined execution. But ultimately, the question for you, the viewer, is this. Has Zoom successfully forged a strong enough foundation to be your next long-haul portfolio addition? Let us know your thoughts down in the comments. Thanks for joining us on this deep dive explainer, and we will see you on the next one.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research and talk to a professional before making any moves with your money.